All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone. It is amazing Thanksgiving week, so I wish everybody a great holiday. And I'm not sure very many people are actually in this week. Typically, we don't see a lot of activity this week as we come into holidays and winding down 2018, if you can believe that. It's really hard to imagine that this year is coming to an end already. Crazy situation. Anyway, a lot going on today. The weakness in the market was pretty surprising to me. We had set up the pattern I've been talking about, but there's evidently a alternative to that pattern setting up right now, and I'll go through that shortly. I've got on the screen here, there's not a lot of news. I talked about this a bit in commentary. You know, today is mostly just jawboning with some Fed chairmans. Tomorrow's housing starts. Next day, we got durable goods, jobless claims, existing home starts, leading indicators. None of these things actually anyone cares about. And then, of course, Thursday's a holiday. And Friday, we've got PMI composite flash. And, this is a really typical holiday week. I expected we would see, some movement. But the type of movement we're seeing so far today is pretty substantial. I think I'll just put that in the background real quick here. And, we're seeing quite a bit of weakness. We've got the composite down 2.6%. And I will go through this in detail, but there's, something I was talking about in commentary is that this has been one of the best earnings seasons as far as performance. I think we're up 25.8% this quarter, and nobody cares. The markets don't care. We're seeing a substantial amount of selling here in spite of some pretty good earnings, and not to mention that there were a lot of companies that beat their expectations, and that's usually not a good sign. And it's like I said, and no one really cares what you did yesterday. They care about what you might do going forward. And the consequences of looking forward is that we're looking at, potential in January, the tariffs are going to double with China. I don't see us getting a deal. Maybe they'll come up with an 11th hour deal and all that will change. But, this supposedly, will do air quotes, that, this is like the strong part of the season. Not so much. And I've been talking about this for the last couple of years, is most of these seasonal expectations, and you see a lot of amateurs, and unfortunately I see a lot of amateur advisors out on Twitter and on LinkedIn that I have a fair amount of followers, and I can see, they tout this stuff, like it's going to do them some kind of good. It's the buy and hold mentality and all that. And, it's really, it's really detrimental long term to be spouting off stuff like that, especially, when you have to try to defend these seasonals. It's just not a good place to go. And, and I made a comment on my Twitter account last week about, God, I hope you're not using these risk numbers, telling your customers how much risk they have. I'm expecting you guys are VPMers, that you've done, at least in some of your slaves, you've actually got a lot of cash or 100% cash. You've changed your overall beta. But there's an awful lot of folks that are going to die by these risk numbers. And, there's one thing to talk about risk. There's something else about doing something about risk. And I guarantee you the customers would rather hear and see you doing something than hear about what kind of risk they're assuming. Because these risk numbers, like a 45 number, when market gets really ugly, like days like today, they look more like 90s. They look like double the risk and what you thought you signed up for. And there's a lot of things that are likely to come out of this, and I think disappointment. So this will, I have not been a big fan. I won't mention any company names, but there's a number of folks out there that are doing this type of risk analysis. And it's a sales pitch for a lot of advisors, tell their customers that somehow they've done something. If you're not a VPM guy, you're not doing anything. You're buying and holding and hoping that diversification works. And when we get into ugly days like we're seeing right now, there is no diversification that is going to save you and do anything. We do see a little bit of, the bonds are unchanged, so there's nothing going on there, to say the least. So let's go ahead and dig into the technical stuff and try to get a handle on what's going on here. So as we look at the daily graph here, we took out Friday's low. The expectation was for us to have at least 3 to 6 days on the upside. The fact that we took out the low doesn't mean it's the end game, but it's going to need to rebound pretty substantially by the end of the day. The numbers that we had out there, 2695.45 was the support 3, which we've exceeded now. We're now 2689.67, which the extreme for the day is 2682.85. We can go over and look at some of these numbers. Let me just see if I can't get us over to. Let's go over here and just bring up commentary for a second, and just look at some of the numbers down here at the bottom, just so you can see exactly what I'm talking about. Here they are, the support and resistance numbers. An attempt to make them a little bigger. That's not going to work on this screen. So we'll go down, but when we look at the support on the weekly basis, 2677 is support 2. We've already went through support 1, which I expected we were going to hold at least 2717, maybe 2707, 08 level, and that didn't happen. So now the next level is 2677, and unless we rebound substantially from these numbers, we're really not going to see a lot of it's going to get ugly as the shortened week actually unfolds, and I suspect that we will see. I suspect that we will see, some. I guess by tomorrow that most of the activity for the week is going to be gone. I suspect most people are leaving Wednesday. It's going to be muted unless there's something that comes out of this. And the disappointment that is being shown here, we're on the heavy selling that's coming in the market is very interesting. And I'm going to show you something that I had talked about a while back, a 5-3-5 pattern unfolding. Then we went up in an 8-day session, and we went up for 8 days, down for a perfect 5, and my commentary on Friday was near perfect, and it was near perfect until this morning. And we should not have taken out 2707 on the extreme. When that happened, all bets are off, and now we're seeing this drastic sell-off that we're seeing. So I'm going to show you an alternative. I'm going to go full screen here in a minute, but I'm going to show you an alternative, or actually maybe the original analysis that I put out a couple of weeks ago was the right one. The good news is that the VPM models are remaining in very heavy cash, so your position, so this is more what I guess if you were hoping for something, this would be more what we were hoping for than, having the pattern up, because the configuration I was talking about is that we would go up to 27.56 to 78. I thought there was a really good shot we were going to get there. That's 100 points up from here just about. And then there was another pattern, depending on what happened out of that we would get to 28.28 to all the way up to 28.56 at 56.64 level. And, the fact is we can't get it back above the 10 and the 21 period moving averages on the daily. And we're also seeing that, the 200-day moving average is a ceiling now, and we can't even get close to that. We rallied above that about 6-7 days ago, and it stayed there for like a day and a half, and it's gone. And so there's a lot of selling pressure. A lot of folks have begun to liquidate and move to the sidelines, and there's more of that happening. Even though if you go on mainstream media and the financial media, I've said this over the last couple of weeks, is like, why would you not go to cash? No one ever talks about going to cash when things get like this. They talk about, well, here's stocks you can own in a downtrend. Why own anything, right? I just never understood that. It's like, just get out. It's okay. You can get back in, and it's very, very low pain. But unfortunately, in our side of the industry, it's become very passive and very, people talking about investments being a commodity. Well, they're not. They're really not a commodity. Customers expect you to do something, and you'll find that out. If you're not doing something, you'll find that out pretty damn quick, for sure. So let's go ahead and go full screen. I want to show you this pattern I'm talking about here. And this pattern is interesting in that it's projecting now, depending on how we close today, unless we close well back over 27.17, we're not likely to see the reemergence of the pattern that I've been talking about for a while. So let's go ahead, and I'm just going to bring up the whiteboard here for a second so I can draw some stuff up here on the far right-hand side of the screen. So we had this little ABC, and the concept was that we would get another A, and this could be a little minor B, and we could still see a C, but there's a growing probability. Let me get rid of that last line. Growing probability that we're not going to get back above 28.16 basis the S&P 500. And if that's the case, then this market's in big trouble. And the next level down, you can see some of these objectives. They might be hard to see down here, but they are. 2601, which would be a retest of the lows that we made several weeks ago. And then the 2520, now 2469 are the next levels down where there's at least Fibonacci support. And those aren't probably going to mean a lot. And we're still looking at the daily graph. And you start to look at the larger scale trends, which we'll do here in a second. There's even more being revealed from this pattern. So let's go over to the intermediate. And you'll see here all the PPMs. This is really huge. You'll see PPM 1, and you'll you'll see over here ppm1 is minus 0.75. ppm2 now has turned negative, which means the 21-week moving average is now declining. And then we have the ppm3 is negative, just slightly, about the same as the ppm2. And it's declining, which tells you that all three moving averages on an intermediate basis are now declining. Not only are we trading below them, they are starting a major decline. 0.76 is a serious number. Those of you who watch the show a long time and understand some of the basic concepts that I talk a lot about is that anything under 0.25 is a downtrend. This is minus, negative 0.25 or greater is a downtrend. Now, we're not there on the second levels of the trend. ppm 2 and 3 are still, they're negative, but not that much. But you're seeing the beginnings of what this thing looks like. And I'm going to draw us a little bit more on the page here. And so if we go all the way back, this is somewhat interesting, I think, is this pattern that we saw coming up to the new highs originally, and there's a couple ways to count this from an Elliott wave viewpoint. First one is that this is wave 5, and over here, sorry, I'm trying to find my cursor, it disappeared. There we go. Over here would be potentially the top of a 3. This entire sequence going up here, I'll draw parallels on it, and I'll draw a down arrow. That is wave 4, or I'm sorry, 5. And now what we've started is a 1, and then this is 2, and with all these averages going down, and then at least we're going to come down to this 2300 number, which is the 200-week moving average. And that's a minimum target. And when we go to the next level, we start looking at the longer-term charts, you'll see that there's even more than that possible. And this is a pretty substantial pattern that's unfolding here. And I think it's important to understand that the short-term charts are definitely all in downtrends. The intermediate is this is the beginning phases. You know, people are looking at this thing, the bottom here. No, this is the beginning phases. In fact, this is the second leg down, which would be a wave 3, which is likely to be a multiple of what the length of wave 1 is. So let's take a look and just see what that number is real quick, and we'll do some. So the high was on this thing was 2940. And if this is the bottom, this is 2602. And so what we're likely to get here, and I'm going to do a couple calculations live here while we're doing this, is that the patterns that are unfolding here. So that suggests that we have what? Let's get this exact number here. I might as well do it right. And by the way, if you folks have any questions or anything, things you want me to cover, go ahead and do that. This is just going to take me a second to figure this number out. This was not on my mind when we started this morning. I expected the support levels to hold. And so we have a length of 338 points. And if we take the extreme, I'm just figuring this up. If we take the extreme expected here, that would be that the next leg, this wave 3 that I was just talking about, would be in a ratio of 1.618 minimum, could be even bigger than that. That's a 546 point, we'll just round it off, 546 point decline, and that would be measured from 2816. So let me give you that number. That's 2270 on the downside. And that coincides with, this is below the weekly average. I was just talking about the 200-week moving average. So let's go over, and I'll go full screen back here in a minute. But this is something I've talked about. We've got PPM1, even on the long-term chart, I'm going full screen here. On the long-term chart is minus 0.48. It's in trend mode down. So the monthly 10-month moving average is in a downtrend. And then we still have a positive sloping PPM2, which is 0.60. I'm going to bring this stuff on screen so you can see it. So at 0.60, the medium average is 26.29. And I talked about in commentary that 26.30, this number is recalculated real time. So it was 26.30 and change when I was writing commentary yesterday. But now we're at 29. So a break below that would tell you that there's much more on the downside. However, there's a however or a but. As with a 0.60 PPM2, the probabilities are only about 30% that we will decline below that level. So there's still a good chance that we'll get down to 26.30. I think that we get through this month of November, which we're over halfway through, and we'll probably stay in this sideways zone. If you recall, and I'll bring up, I think I've got a graphic I can bring up pretty quickly here. And in fact, let me just see if I can do that. I believe it's in, I believe it's here. Maybe I'm wrong. Let me go back one other folder. Wrong. So I thought I knew where it was, folks. Let me just see here. Yeah, I'll bring it up. I know another place where it's at. I thought I had it available in the folder. I've been working on 2 different computers from remote, and I think I've stored everything away from here. But anyway, there's a couple numbers that we need to be aware of. But the pattern that I'm expecting is that we go into a sideways range, and that range is likely to stay between 26.30. We'll call it. We'll round it off. 26.30 and that upper 28.16 number. Now with the kind of weakness we're seeing today, we may not be able to get back over 27.50. 77, 78 is a big pivot number. That may restrain this thing. But I'm not sure we're ready just to collapse from here, but certainly what we'll start to see even more of, which we've seen a lot of, and I'll go through the VPM database here in a minute, but what we've seen a lot of is that the underpinning of the markets, and I've talked about this for a number of weeks, is that our database has been completely decimated. We got down to 11% of the symbols in our database out of 17,800 were long. So basically almost, we'll just say virtually all the trends, 90% of all the trends that are in the markets have been destroyed. We're even in a neutral phase or a declining phase. Either one, no matter how you want to look at it, there is no uptrends. There's no basis for this market to move higher on. And this is how we start. If we go back, those of you who've been around a long time with me, we go back to 08 and 09, easiest call I've ever made in my life, believe it or not. People patted me on the back and all that stuff. But it was easy because it was everything was very visible from the standpoint. We knew there was a banking crisis. We knew there were things going on with the housing and the mortgages. It was like right in front of us. And if you chose to ignore it, then, you got punished for that. In this case, it's much more obscure. You can't see what's going on behind the scenes as easily or say, oh, this is the reason why this is happening. And that was simple. And certainly mid 07, 08, those were all really simple things to figure out. And of course, when, Hank Paulson and the guys came in and started the first QE and the TARP program and all those old things that happened, that was real simple to have to understand that, hey, they're putting money in, markets are going to go up. The VPM database flipped in March and April of 2009, and we ended up with a 35 to 40% gains on our average accounts that year. what a wonderful, we protected, only lost 5 to 10% on our worst strategies, and on the upside the following year we make 35, 40. I remember our 2010 conference. It was like you say you get your 15 minutes of fame, and maybe that was it for me. It was, almost not quite a standing ovation, but we had a wonderful time at that conference because we just killed it. We missed out on all the downside. We made all the upside. Then things got harder, and we had the European crisis. And so one of the things I almost put in commentary last night as I'm going on this little rant is that, does Brexit matter? Do the things going on, are we looking at, a European crisis 2.0? There's a major war going between the so-called nationalists, even though it's hard to call the UK that. They have so many different factions there. But going against and leaving the EU, is this really what's going on in the backdrop? Are folks, is this international offshore selling? And, where's this stuff coming from? So it's getting pretty tense over there. And I hadn't really thought about the intensity that we could see from that. I guess I did think about it. I almost called the headline for yesterday's commentary, or for today's commentary, was, does Brexit matter? And, is it European crisis 2.0? And maybe it is. And maybe that's what we're seeing here is a lot of European selling, overseas selling, just raising cash ahead of time. So let's take a little bit more in-depth look at this monthly graph. And the monthly graph, we're like I said, we still have some pretty good numbers on the upside, but if you look at the PPMs over here on the right-hand side, you'll see that all three of the PPMs, PPM 1, 2, and 3, have all penetrated their first and second derivatives. Those are the green and blue lines on the charts. And by doing that, it's telling us that all the trend, everything's inverting. So we're now getting into a downtrend. We've been in this uptrend going all the way back to 2016. We finally hit a glitch, in the beginning of this year. This year has been pretty interesting if you look back on it. And and it might be possible that we actually challenge the lows of February, and that number there is 2532. And if you think about what I was talking about just a little bit ago when we were looking at the weekly charts, I was talking about a range of 25, 20, 30 to 2450 level as a target range. So that would be a retest of the lows of this year. And I suspect it could happen, but like I said, I don't think it's going to happen. And what I'm going to do here, I have, I'm going to go back to the commentary here. I was going to show you this chart. Here's the chart I was talking about here. And this is, my expectation was we'd get this leg up. So now instead of that, this is all going to move over. So depending on how we close today, when I update this graph tonight, this stuff over here where the arrows are will be slid over, and we're likely going to stay under 28.16 now. So now the new trading range is probably 26.30 to 27.56, maybe 78, around that range. We might get back to 28.16, but it's looking like less and less of a possibility at this time. But this last section is going, and then I've got projected as we come into 2019 as a very negative situation moving forward. So the results are a number of things that are likely happening here. And those things that are happening are combination of, you've got we'll call it a balance of power, in that the House is being controlled by the Democrats. We got Republicans on the Senate. There's a lot of things that Trump can still do with just the Senate that move an agenda forward. But there's going to be just, I can't even imagine the noise, the so-called Russian narrative that, is going to come up, and impeachment. There's going to be all kinds of disruption potentially, which can't be good for the markets. When you have that kind of noise in the background, it's really tough to have, a positive market going on. So if you happen to be hoping that Trump fails, then you're at the right place because you're in cash right now. And I think that the patterns that we're seeing is going to stay in the sideways range. And, I expect that as we come into 2019, supposedly another positive beginning of the year, the first, typically the first quarter is positive. I don't think we see any of this stuff happening. If you look at the FANGs and you look at, I don't know what you folks think, but Facebook probably is. People laughed at me 5 years ago. I said, Facebook won't be around, 5 or 10 years. It'll be non-existent. And if you look at what's going on there, it's certainly imploding. You got a lot of amateurs running that place, including the guy at the very top, right? And, now he's getting tyrannical with people, and you can't have iPhones and all kinds of really crazy stuff. So, you're just seeing that corporate, it's falling apart. Let's put it that way. The whole scene in the background is falling apart. So it's going to be interesting to watch. But meanwhile, we've seen Apple under huge pressure. And I'll bring up Apple here in a little bit. But, I was joking with a friend the other day. I said, Apple can't bottom until they take out Warren Buffett. Warren Buffett's probably, I know maybe you folks idolize him. I think he's one of potentially has been involved in more insider trading. I mean, he went to Apple campus, kind of walked around. You and I couldn't do that. Finds out all kinds of stuff, then buys an ungodly amount of stock, right? And then he advertises it so everybody knows, oh, Warren Buffett's buying, and they get another surge. I mean, this thing can't bottom until, Apple's got to go to 160, maybe 140 before, the game's over. And it'll be interesting if we find out that old Warren was selling when it was up in the above 200. That would be very interesting if he all of a sudden was lightening up. And this is what I say, it's a classic, in my view, that last trade was a classic pump and dump. And especially if we find out this guy is actually sold. But regardless of that, there's just a lot of pressure. There's a lot of sellers out there in the FANGs. You look at what's going on in Amazon. Maybe we'll go through that here in a second while I'm babbling on. I apologize for getting in depth on this, but I think there's a lot going on that we need to consider. So let's go back over and let's look at what's going on in the composite real quick. I think this is significant as well. Composite down 269 right now. This is the monthly, and you can see we have a similar number, but the composite PPM2 is at 0.85 positive. So there's less than a 20% probability for the composite to decline below that level. And let me show you what that is. That level is 69.53. So about 100 points below where we are right now. That is probably going to be rock bottom. And I think the same thing, all these indices are telling the same story, is that we're coming into this sell-off will bottom, and then we set up a trading range. And I talked about this, I think 2 weeks ago, is the depth of this sell-off will tell us about the nature of the next events to occur. And what we're seeing here is this is a pretty deep correction. We went all the way up over you can see here, I'll put a cursor there. We went back above the 10-month moving average, which had flattened and now has turned down. And now we're locked between the 10-month and the 21-month. And if we look at those values, they are 20 or 74.53 to 69.53. So we have about a 400 to 500 point range that we're likely to stay in for the balance of this year. So as we look at this stuff, this is going to be the setup, but it also tells us that there's a bigger issue going on. So let's go over and let's take a look at, I just want to go over here and we're going to take a look at, make this just a bit smaller here. But what we want to look at here is we're at 13.52% long. So we've picked up about 2% in stocks. We did see somewhat of a positive rotation this week on the database. You saw 621 buy signals by 120, so we'll call it 500 new on weekly 3.2, and we were slightly negative still on 1.2. So there's a little bit of positive rotation, but certainly not material. This database isn't going to flip until we get well above the 40%, 42% level. We're at 13.52. Utilities continues to be the only thing that is long, and that's based upon some the interest rates pulling back. So it makes sense that sector, even though as a group it is down about 0.75% since VPM issued a buy on the group or on the sector. And if we head over here and take a look at the sector electric utilities, which is interesting because I can't imagine that PG&E is doing well in there, and natural gas utilities has a little better representation. So there's still some pretty good trades that are going on here, and some are in the middle of their cycle. So this would be why this index is actually continuing to show some positive rotation. Let's go over to the dashboard on VPM, and let's just take a look here. And you'll see some of the rotation. It's taking just a second to refresh here. I'm impatient. I'm going to trigger it again. Just kind of spinning. There we go. So we look at some of the rotation. We continue to be about 30 to 40% on average invested across the category. Now this is individual equities. And as we go down, we go up here and look at the individual groups. You'll see this is a rotation precious metals, which is interesting. We'll get through gold here in just shortly. But you're going to see the type of sectors that are seeing any kind of flow. You can see textiles, retail under pressure a little bit. See home furnishings saw a 20% reduction in holdings. So you're seeing, it's interesting that financial commodities are in there pretty good, up 69%. It's one of the only groups, along with REITs, that are hanging in there pretty good. And you can see this is where positive rotation and employment services and heavy electrical equipment, kind of obscure sectors and groups that you don't spend a lot of time looking at. But that is where the rotation actually has been occurring. So let's go ahead and go back to TradeStation. Let's take a couple of looks. Let's head through the interest rates a bit here. We are down. This is just fascinating me, to say the least. What's going on here? Let me just go over and let's start at the daily graph. Go full screen here. And what's interesting, I think what's interesting about this particular thing is that we've seen rates drop all the way back to 305. I really didn't think once we got to the 324 level that we'd go much under 312. We've seen a lot of protection being taken with this selling. And once again, I'm willing to bet maybe it's European selling or buying into the treasuries, they're selling equities, buying treasuries, and there's a bit of a trade going on there. And that is certainly what it appears like is going on. And with the Fed lurking in the background that they're going to raise rates, then that's going to, I talked about when the last increase happened, prior to the increase, we already priced in December all going up to 3.25. So my guess is we're probably pretty darn close to the bottom of the yield spectrum, and we'll probably move back into 312, 315, and everything's going to be, I mean, it's year end, everything's going to be consolidating unless there's something that's going on, whether this, if Brexit is real and it is a problem, that might be the driving force as we come in to this year end. So don't be hanging around expecting a kind of seasonal fun. Those Santa Claus may not be coming this year. So we'll say what's going on there. But as we look at and we go into the intermediate graph here, you'll see this trend. I'm surprised we've gotten below here, but we're still positive. 0.21 ppm 1, ppm 2 is 0.33. Anything over 0.25 is an uptrend, and those values are, looking at that, we're 3.13, so we are trading at 3.06, roughly, rounding up a bit, and the medium average is 3%, or call it 301. So we are, once again, just like in all these charts, they're all configured the same, all related, obviously, in between the 21-week moving average and the 10-week moving average, and that's your range, 313 to 3%. So we're just going to be locked in this range unless, like I said, there's an outside influence and Brexit becomes bigger. If we go to the next level, then maybe we can see the 10-year dip below the 3% level. Let's take a look at the yield curve here real quick. And let's just go full screen. So as we look at this, you can see, once again, while these rates are coming down, we're actually starting to see the 13-week T-bill at 230, and then we're seeing all of the longer term, the 5, 10, and 30-year maturities are dropping pretty quickly, with the 5 leading the way. And as we look at some of these other charts, look at some of the spread charts, you will see that we're seeing a steepener set up, and this is very likely to continue. This is the first time we've seen a real sustained move on the upside here. You can see since July, we're continuing to see a steepener here. And the same thing here. This is looks like the 1030s over here. Also steepening. They really didn't start until September. And then last but not least is the 3 or 2 5s. And these are seeing a little bit of steepener, but more of a stabilization from where they've been. They flattened way back, and now we're seeing a little stabilization. And what this tells us is that, I've talked about this before, this is building expectations that the Fed will raise rates and continue along the path that they have been talking about for a while. And like I said, there's no way that the Fed can back off of this thing. It's they've made their statements. They have to stick to it, or they lose all their credibility. And I've been doing this for almost 40 years, which is a scary thought. But back in the days, I was talking with an old buddy the other day. We were reminiscing when back in 1979 and 80, when the biggest thing out there was money supply. That was the thing that everybody watched, week-to-week money supply. And the bond markets were incredibly volatile. Of course, we had pushed up in early 1980 to 16% on the long-term yields, and the Fed funds were 17 with a 3 to 4% surcharge, which put them at 21%. And of course, it was the exact extreme. So in my career, I've watched us go from 20% to 0. And so we know that the only way there is now is to go back to normalization and higher rates. And like I said, the economy, the economy works fine at 5-6% yields. It's just that there's an adjustment period, and the cost adjustments have to be made. Things are much different than they were certainly back in the 80s, and from the complexion of demographics of the markets and who's buying, who's selling. Real estate after the crisis is still a major factor in the economy, but not as big or perceived to be as significant as it has been. And I don't know if you folks saw that comment by Jeff Bezos the other day, and he was telling his executive staff that Amazon will go out of business someday. Their job is to delay it as long as possible. I love that. It was an amazing comment, but it's the same thing with I think the country right now, is that when you have pushing $22 trillion worth of debt, and I haven't harped on the debt for a while, but since we're talking about interest rates, it's important to understand that it's not sustainable. And I keep saying, what number is it? Is it 21, 22, 23, 25 trillion? What is the number that finally everybody realizes this is not sustainable, and that the markets start to react substantially? And is there a bond bubble? Absolutely. Is there an equity bubble? Probably so. The question is how it gets unwound. And, there's just about everybody, including probably the biggest investor on the planet right now is Japanese, Bank of Japan, because they own something like 80% of all the ETFs in the country. They even price the equity assets so they can control them. I don't know who they sell to. I don't know how they get out. So if it starts to decline, I'm not sure. It's going to be interesting to watch that market and see how it works. But at some stage, it's not sustainable anymore, and things have to change. And that's exactly what we're seeing. So let's go. Let's see here. We got about 15 minutes to go. Any questions would be awesome. Just go ahead. This would be a good time to do it. Let's go ahead back and let's bring up Facebook. I'm anxious to see how that thing's doing. I haven't looked at it today. Look at this thing weekly. It's breaking through its 200-week moving average. This thing is a death spiral. How far it goes down, I suspect maybe all the way down into maybe another 50% from here, maybe into 60, 68 level. This thing is in big trouble. You got PPM 123 minus 1.97, minus 1.74, minus 6.5. So this company is in big trouble. It's not General Electric, but it's got problems, and there's nowhere for it to go. They're really in a spiral that I don't think can be stopped at this point, and this is going to continue. So let's take a real quick look at the monthly graph here, and I'll just leave it on the screen on the side for a minute. Not a lot there, but we broke it through all the monthly. There's not even enough calculation on this chart. I can go into VPM and show you this, but it's not necessary. So we have the monthly PPM1 minus 3.14, minus 10, but this thing is completely rolled over. So I suspect the previous level, there it is, somewhere around, we'll call it 98 to 72. Maybe this level here will hold about 115, maybe 100. This stock's got a lot to go, a lot of ways down here. So let's go ahead and switch over to. We'll look at some of the others. Let's look at. Let's do Apple. I fat fingered that. Sorry. Apple, similar. We went through 200-day moving average. It's down another 3.53% right now, and we're looking at some pretty big numbers, minus 0.75, minus 0.75, and minus 0.40 PPM 1, 2, and 3. And what that tells us is that we're in a major downtrend here. Let's switch over and go to the intermediate. I said we're about $20 from taking out WB, Warren Buffett, and I really think it's going to be interesting. I'm not sure if there's any filings made. There should be. Like I said, it's going to be interesting to watch what the activity around Berkshire is, because I suspect there's some games going on. But look at the PPMs here on the weekly. 1.72. I'll bring them on screen so you can see that, and I'll go full screen so you can really see it. But you're looking at one down here, MM01 minus 0.172, flat on PPM2, and then PPM3 is also still slightly positive, but we're at the beginning phases of this rollover. And as in Facebook, it's likely that we will go back to this level here, which is going to be the 160 level. This little spike up, let me go to a whiteboard here. So this spike right there, this spike right here is where Warren announced his purchases, and he was buying through this whole area. Then they come out and say, oh yeah, by the way, we bought X billion dollars worth of Apple. And so everybody went up and bought along with them. We got this thing here. And now we're getting the stair step down, where no one's talking about whether Warren Buffett owns this stock or not. And hopefully he still does. Hopefully this guy will lose some, 20, $40 billion for trying to manipulate markets. My opinion, of course, but I believe that's what's going on here. But this pattern is definitely very negative. We could go all the way back, toward this 200-week moving average, 140, 150 easily. This is an easy story to come up with. And like I was saying earlier in the show, it's not as simple to come up with like in 2008 and 9. Oh, there's a banking crisis. This is what's going on. All this lack of liquidity. What you're seeing now is what it looks like when everybody on the planet owns stocks. Everybody's long, and they keep selling. So we get this little blip, and that's why I was talking about earlier when we were looking at the S&P 500. This is why we do not get above that 2816 number. That was right after the initial move down, we rebounded back there, and that's been the ceiling in this market basis, the S&P 500. So this is a pretty negative tone. Let's go through a couple more fangs for fun. Let's go. None of these stocks look good, by the way. So here's the weekly Amazon. So we went from 2050 down to 15. What was the low there? Down to 1476. So these are big time moves. And not only that, you look at the PPMs, minus 2.50, minus 0.46, and a plus 11, which is flat because the longer term average is just starting to roll over. Ultimately, what will happen is all three of the averages will be going down. Amazon will be in a downtrend, which is typically going to last anywhere from 12 to 18 weeks, I would think. So we have a lot more downside. Maybe we'll catch some kind of low and it'll start to consolidate. Maybe we can build off a base. But for now, all of these things are massive downtrends, and they have been for a while. What else we got? Let's see here. Let's look at NVIDIA. Boy, this is another ugly one, right? These are all the sweethearts that were climbing all the way through 2016 through 2018, and now everything has fallen. This is the other thing that you need to understand. There is absolutely zero leadership in the market. There is leadership, but it's all on the downside. Let's look at one more thing, because I've been kind of going on and on. This is I want to look at this. This is what I've talked about for a very long time, and these charts are finally breaking down. This is the S&P, long S&P versus short EEM, and the other one's of EFA. And you can see both of these are pretty substantial. Let me get one more here, Spider SPY. So this is the EFA here, and this is exactly what I'm talking about. You're seeing a huge move down. Where this is the break of the pattern that we've been waiting for a while. There's still some, I guess, uptrend or support on these charts, but this thing is just, I believe, is going to continue to come apart. And as this comes apart, then this will just make more of the story and why the markets are going to continue to decline for a while. So we got just a few minutes to go. Questions, please put it on the chat line there. Anyway, as we look at what's going on in the markets here, I'm going to go back to some of the indexes here, and we'll kind of. I said I was going to go through gold. I want to go through that. Actually, I want to go through the Dow real quick as well. Let's do that first. So this is the weekly Dow. And I was kind of trolling Peter Schiff the other day. He was talking about this thing's going to collapse. Well, with the rates coming down, it's interesting. We've been pretty stable. We're at 96. We got up to around 98 and change, which was the upper end of my expectation. And I think, like I said, all these markets are all related in the patterns. They're different phases where the Dow is up at the high end, consolidating. The equity markets are at their lower end of their spectrum, consolidating. And before we make the next leg likely is up on the Dow, and it's going to continue to move higher. I think the Fed will raise rates. We will see that normalization continue, and this is going to be a continuation of the problem of the process. Let's take a look real quick, and there's two other markets I'm going to hit on real quick. We're going to go from the Dow to gold. We'll go to crude, and then we'll finish up the show at this point. But what we're looking at here on gold, this is the weekly gold. We're really seeing a nice rounding bottom. We're seeing positive PPMs. I'm still have an expectation for gold to move to around 1270, 1300. In spite of the stronger Dow, I believe this is a place, and I've talked a lot about this. If you're put GLD or your favorite ETF or ETN in VPM, and when it tells you to buy, make sure you're on this gold trade, because I think ultimately there's a 1400 gold, out there as the markets unfold. Let's take a quick look, and you'll see this. It's more evident on the monthly graph. So this is definitely a commodity I would look to own. This thing's been basing forever and ever, and it's just going to take a move above around 1270, 1300. Above that level, this thing's off the races. We're going to move not to 1400, but probably 17, 1800, and maybe even challenge the old highs at some stage. So there's a very good chance. If you look at when, the European crisis is when gold made its high. Let me just mark that out so you can see this. Back in the high on gold was made in 2011. And this was at the height of the European crisis. So if the, Brexit is European crisis 2.0 or the beginning, because the big war zone is the Europeans are still hanging on, trying to drive the British into staying in the system, right? And if they break out of the system, then they know they have other risk. And it's called Italy and Spain, and there's other risk on the peripheral, because it's nearly impossible to run your country, out of Brussels when you're in Rome or somewhere else. It just doesn't work. You need a local currency. It was a great idea, and that whole EU project goes back a long, long ago, and there's some interesting documentaries on that as well. But the point of it is that this is a place for a hedge against a lot of this stuff. So I would definitely, if you don't have this as an alternative, I would have some sleeve that I was actually looking to protect my money utilizing gold. So let's do one more, pretty close to the end of the show here. let's go up and take a quick look at crude oil. And crude is broken down, and this is a monthly graph, so I'll leave this up and I'll go full screen for a sec. Is what you're going to see is that crude oil on a monthly graph, I remember talking way back in 2016 and back here when we were hitting the lows in the first quarter of 2016, everybody was talking about us going to zero, $10 and all that. My pattern that I talked about is that all three of these averages, the 10, 21, 40, would converge, we'd rise above them, and then the typical pattern is we come back down to the lowest average in there. If we don't hold at this level, and we've got some PPM1, as you can see here, is minus 0.75. It's over here. You see my cursor on the left-hand side. And if that continues and we don't hold at these moving average values, which is 57 to 55, we're trading right in those ranges now. If we don't hold right here and set up some kind of consolidation range, then we could go to the next level and we could come all the way down to about 52 to 55. And if that happens, then maybe that suggests that there's also some softening in the economy and demand is starting to fall. And I don't think the Saudis are going to be able to lower production enough to make a difference because the U.S. is now a major player and we're probably going to continue to pump away. And that's not going to be as easy control as it used to be. There's actually just a few handful of people, and the U.S. now has a real say-so on what's going on in crude oil. So let's go ahead and finish as a summary here on the markets here, and I'm going to go back to a daily S&P 500. So because of the holiday week that we have, my expectation is that we will find support somewhere right around here. We may have this has happened many weeks in the past that Monday ends up to be the low of the week and we'll see recovery. This is going to be an interesting week because it's a holiday week and it's going to be what I thought was going to be fairly slow, and volume's not too bad. We're about 56% of Friday's volume now, so volume's hanging in there fairly good. At this rate, we'll easily at least equal Friday's numbers, and probably tomorrow will be pretty good as well. It's just Wednesday will start to fall off, and Friday will, I suspect, to be down 20 or 30% off the normal volume numbers that we see. And so, my expectation, like I said, I'll just set it up real quick again, is that we're going to stay in a range. I just saw this, so if you're still online, I will go ahead and I just saw the emerging markets, so I will touch on emerging markets here real quick. But this pattern that we're likely to see is going to bottom today. Maybe we see some slight weakness tomorrow, but we should go on. So let me do that real quick because I didn't see that question. I'm not sure when it came in. I was kind of looking over there, but I didn't see it. So let's take a quick look at EM. And EM is actually starting to look like this is a daily, like it's starting to bottom. It's like this is almost an inverse of what's going on in the U.S. markets. Even though we're down a $1.30 today, 1.3%, down 53 cents. What we're seeing is this is going to be your key high here at 41.70. So if we can get above 41.70, about $1, then you probably move back toward the 200-day moving average. We look at intermediate chart. We're going to look at this has been a really, just crawling along the 10-month or 10-week moving average. And it's still at minus 0.39, and so there's a lot of resistance. It will take several weeks, but as in the other markets, I suspect that we'll see some sideways movement. This is actually a much better, this is interesting, this is a better pattern to set up a bottom than any of the other markets, the domestic markets or anything else we've looked at so far. And let me put EFA up real quick. There's no one telling us we have to stop at 1 o'clock. But anyway, this pattern is a little more negative. So the emerging markets, which has been hammered down pretty good this year, is got a better pattern for a possibility as far as actually bottoming than any of the other markets going. But this one isn't terrible. But, you know, if we're going to see this European crisis 2.0, then that's very possible that, you know, all these markets will have one more leg down before they hit bottom. From a PPM standpoint, all three levels on EFA are minus 0.67, minus 0.33, minus 0.33 on PPM 1, 2, and 3, everything in a downtrend. So there's certainly no prospects at the moment for any kind of major move. So anyway, folks, listen, have a great holiday. I mentioned in commentary that there will be commentary tomorrow and Wednesday. Our support desk would be open on Friday, of course, closed Friday or Thursday. So have a great week. Enjoy the holiday. Don't overeat, all that kind of stuff. And we will talk to you next Monday. Thanks for watching.